As we gather, I invite you to join me in prayer. Let us pray. O God, you have made us in your own image and redeemed us through Jesus, your Son. Look with compassion on the whole human family. Take away the arrogance and hatred which infect our hearts. Break down the walls that separate us. Unite us in bonds of love, and work through our struggle and confusion to accomplish your purposes on earth, that in your good time all nations and races may serve you in harmony around your heavenly throne, through Jesus Christ our Lord. Amen.
Amen. Welcome to the SEEP Network 2021 Annual Conference. For a time such as this, the Church as Witness. We are the Endowment Trustees and Committees members pre-conference session 2, discussing Parish Endowment Investment Committees and the COVID markets. My name is Deirdre McElroy. I'm a member of St. Bartholomew's Episcopal Church in Baltimore, Maryland, where I chair the Endowment Board of Trustees. And I collaborate with SEEP on endowment and multiracial church content, and I'm here today as your host and moderator. I will be sharing your questions with our presenters as we go throughout the session today. We live in interesting times, and we are called as ever to seize the opportunities that exist for our missional endowments. We want to help you fulfill your vision and mission to transform the world. To do so, we must enrich our knowledge and our toolkits. This session is designed to help you be savvy and primed. We aim to increase your understanding of the investment landscape, of the dynamic and transformative capital market systems underway in impact investing, and to show you how investors are generating justice where it has not yet visited. Increasingly, we realize an economy that doesn't work for our society or environment isn't an economy fit for the 21st century. Missional investors are seeking change big enough to deliver a capitalist economy that works for all. The COVID-19 pandemic crisis has revealed and also amplified the disparities built into our economies and our market systems, but opportunity is knocking. There are many moving parts to connect as faith-based investors change how business is done and who benefits. We, our endowments, have the opportunity to help transform the world and deliver a more shared prosperity as actual impact. We can help address key social and environmental issues as part of their recovery. In doing so, we believe endowment investors will realize greater resiliency and sustained missional success. How pleasing to our Creator. To kick us off is Bill Jarvis. Bill is Managing Director of Market Strategy. He's a delivery executive with Bank of America based in New York. He's an expert in investment policy and governance for endowed organizations, and he's responsible for strategic thought leadership with institutional and private philanthropic clients. Bill is a frequent contributor to our endowment content. He is an important voice among our experts today. I have asked Bill to contribute at both our start and our close. We will hear from him now an economic and market overview, including factors that may impact your investment committee endowment decisions. Bill is going to be speaking to us fireside chat style. So tuck in and let's learn. Take it away, Bill.
Well, thanks, Deirdre, and thanks to all of you for joining us. Many of you were on the morning session, and it's lovely to be back again. My role here is to set the stage in giving an overview of the macro trends that are influencing investment markets now, bearing in mind that when we think about endowments, as we learned this morning, we're talking about the very long term. We're talking about perpetuity. And so the things I'm going to refer to are things that we believe will influence markets in the next 12 to 18 months. It's hard to see much farther ahead of that, except in a very structural sense. But we have also provided, and these will be available to all of you afterward, some papers that we have written through our Chief Investment Office on these matters. I would refer you particularly to one whose theme says it all. It's called A Marathon, Not a Race. And this is where we are in endowments and in real life. So let's think about where we are now. We've been through this pandemic year, this catastrophic year, and year of tremendous rebound, year of stress for many of us personally and for our organizations, for our churches. In 2021, our Chief Investment Office and our researchers at Bank of America are looking for much stronger economic growth in the GDP sense, for stronger earnings at companies and stronger profitability at companies, which is a good thing. And also, and this is something that I'm sure many of you are concerned about, and we'll discuss, our other panelists will be discussing this in more detail, a bounce back in inflation, not necessarily in historic terms, such as would have happened when I was a young man and inflation hit double digits, but still something more than what we've had recently, but that the Federal Reserve under Jay Powell seems basically resigned to accepting, mainly because they've taken more than 10 years of trying to sustain inflation and they've always undershot their targets. Now, in this sense, we're looking at a market, therefore, with low interest rates, with close to zero nominal interest rates, and some of us will say negative real interest rates after inflation. But in this market, with stronger earnings, with stronger profitability, stocks, equities, will outperform bonds. Nevertheless, your yields, that is to say, all-in return on, for example, a 10-year Treasury note, we view is likely to come back up toward, say, 2% in the course of the year. Now, when we think about earnings on equities, we're talking about earnings per share, which is a standard metric, and these then drive the stock market performance. So if we continue to have solid earnings, and in the last 6 to 8 months, we've certainly had a situation where analysts have predicted what earnings would be based on their estimates of a company's profitability, and many companies have been beating those earnings, have been outperforming those estimates. So we feel this could as much as double the historic performance for stocks, for equities. Multiples, that is to say, the price of a stock relative to its earnings could be a little bit higher, but the point here is we're not looking for all the way up. There will be some setbacks from time to time, but sort of grinding higher. These market returns often are not respected when they start because people can be pessimistic, but we view the earnings as the background for a higher equity market going forward, certainly in this year. Our bank, in terms of GDP, recently raised its GDP growth estimate, gross domestic product estimate, to 6.5% for the year. And this is pretty aggressive. It's more than a percentage point above what other analysts in the market are saying. I'd be interested in what our colleagues on the call have to say about this. But this still might be too low, given the monetary and fiscal stimulus that was received last year, and that it looks as if may also pass both the House and the Senate in the next few weeks, combined with this pent-up demand for discretionary spending. In other words, for many of us who have been at home, savings, as we know, have been up. We get further through the vaccination process, the economy is gradually opening up, and people want to go out and enjoy themselves. They don't want to spend on goods anymore. They want to go out to restaurants. They want to go out to performances. They want to go on vacation. And this could certainly be a major part of growth and of earnings in the rest of the year. And earnings could accelerate. It's a little crazy. I did the math earlier this morning at a growth rate more than 20 percentage points year over year. In other words, the earnings at the corporate level could be 20 percentage points higher than before. So we're pretty optimistic on this. And the sensitive sectors to the economy, that is to say, as I said, consumer discretionary, financial stocks where banks are lending again, materials and energy stocks where we're seeing much more in the way of information technology and so on, and of course industrials, are going to be at the center of this. Small capitalization stocks will also share in the recovery, and surprisingly, emerging market equities and even Japanese stocks should do very well. Now, when we think about how all of this works in terms of the themes, we're thinking about inflation and we're thinking about growth. I mentioned inflation, possibly as high as the sort of mid 2.5, 2.7% range as we go out of the COVID-induced price declines a year ago in the upcoming months. And the Fed is going to tolerate this. They're going to remain highly accommodative, especially given this period of, as I said, a decade-long period of inflation that was undershooting the Fed's target at that time, which was 2% or so. Now, we're still following the science. And so the science is going to be the key. We see the economy reopening. We see the vaccines being distributed. We don't know whether there will be renewed outbreaks. We don't know whether that will lead to shutdowns. But at the moment, things seem to be poised for this stimulus that has gotten us over this abyss of insolvency and financial collapse. And the light at the end of the tunnel, obviously, is this ample rollout of the vaccine in the coming months. As I said, the earnings have beaten analyst estimates by 15 to 20 percentage points in recent quarters. And so, for example, in the last quarter of the last year, the fourth quarter of 2020, earnings beat estimates by more than 17%. Importantly, we're also seeing something that we haven't seen in a while, which is stronger productivity. That is to say, more output per input of cost or labor, which is also adding to an upside boost in economic activity. And if this is the start of a permanent shift to higher productivity, you're finally getting some benefit from all of the investment that's being made in the last several decades in information technology and so on, this could help to perhaps temper some of the challenges in the very high growth, as some would say, explosion of federal debt from less than $1 trillion to more than 28 trillion over the last 40 years, this big expansion of federal debt. I would say, to conclude and to hand it back to our panelists, the other paper, one of the other papers that we have for you is one whose title says it all. It's Themes, Not Memes. And we've all heard about memes in the last few weeks with various things, but we're following six themes that we think bear further investigation, and they're gone into in more detail in the papers. I don't need to revise that here, but the first is big data. Not only cloud computing, data analytics, artificial intelligence, but also humble things like data centers, these places that are being built to process all the information that we're generating. The second, demographics, longevity, but also next gen, millennials and Gen Z that are coming in and are being economically active later in their lives than the baby boomers, but now they are becoming, in some ways, the determinant of what is important for the economy. The third theme, climate change. It's real, it's here, and this administration is doing something about it. We're seeing more in terms of not only alternative energy, renewable energy, solar, wind, hydrogen as investment opportunities, but also energy storage, distribution, and then water and waste management, typical infrastructure. The fourth theme, mobility. This is smart cities, autonomous vehicles, all those things you read about in the papers. They're on the come, they're not here yet, but clearly the model of the past in which people owned cars, which they drove a certain number of times, a certain number of hours a day, and they sat and were inactive for most of the rest of the day, may be coming to an end. Fifth theme, security, information security, cybersecurity, all of this type of thing that we've heard about, and again, that's been accelerated during the pandemic. And then finally, this look at the post-coronavirus world. Supply chains, do things come back to the United States in terms of manufacturing? What about health tech? What about remote provision of health services? E-everything, e-commerce. And finally, another topic that we're going to focus on today that we talked about earlier this morning, environmental, social, and governance factors and metrics as features in investing. So this is kind of where we are, a place where after going through a really horrible period, we feel that there is a potential for strong growth and for some optimism going forward, not least because of the vaccine, but also driven by this suppressed demand now coming out and these other thematic or generational factors. So with that, I'll hand it back to Deirdre.
Thank you so much, Bill. Thank you for the capital markets outlook, the sector insights, and of course, the big themes, and for setting us up. We have a wonderful group of experts with us this afternoon, including John Riley with 1919 Investment Council, Sonia Kowal with Zevin Asset Management, Scott Clemons with Brown Brothers Harriman, James Malone with Community Capital Management, and Becky Brooks with Morgan Stanley, in addition to Bill Jarvis with Bank of America. Thank you, Bill. We're going to actually turn now to our friend Scott Clemons. Scott is Chief Investment Strategist for Brown Brothers Harriman's private banking business. He's one of the firm's primary writers and speakers on topics related to the economy. You can frequently see him quoted in the New York Times and the Wall Street Journal and WAPO, and sometimes see him on CNBC and Bloomberg TV. Lesser known fact about Scott is that he has a really great sense of humor. He's a really important strategist. We're very happy to have him with us today. And Scott is going to talk to us about how the pandemic has forever changed the world in which we live and work. He will provide some insights and Brown Brothers Harriman's best thinking as to what the post-pandemic world implies for both the economy and the markets. You have the mic, Scott.
There we go. Now I've unmuted the mic as well, and hopefully you can see the screen in front of you. Thank you, Deirdre, for that introduction. I'm new here, so it's very delightful to join you. Good afternoon, good morning, depending on where you are. Brown Brothers Harriman partnered with the Church Investment Group just about this time last year. So I've become very good friends with Joanne Hansen as we've sought to build our business together, and it's been absolutely delightful. Maybe because we're new and maybe for some context to my comments, maybe a word or two about Brown Brothers Harriman for those of you who don't know the firm. We were founded in 1818 as a private partnership, and 3 years later, we are still a private partnership. So there are 32 general partners, 32 men and women who own the firm outright. There's no outside capital, there's no debt on the balance sheet, and we carry joint and several unlimited liability for the obligations of the firm, which is an ownership structure that tends to focus the mind, as you might imagine. We are very long-term patient investors, patient compounders of capital, and I think given the fact that we have focused so much on our own sustainability over the 200 years that we've been in business, we have found it rather comfortable and appropriate to adopt sustainability principles, to incorporate ESG into our investing. Signing the UNPRI was a relatively easy process. We have about $5 billion that we manage for endowments and foundations. And I particularly enjoy it because I sit on your side of the table. I'm on a number of endowment boards and chair investment committees, and really have a deep appreciation for the work that everyone on this call does. When you work for a 200-year-old firm, you tend to gain a certain appreciation for history. And even though we think of this pandemic as being so unprecedented, a quick look at the history of pandemics illustrates that it is by far an exception. That actually is the norm. Plague and pestilence have accompanied humankind for the duration of our existence. So just to put things into context, the little red box on your screen is the COVID-19 pandemic. It makes the league table, don't get me wrong, and the human toll has been absolutely terrifying. But relative to a lot of other eras of history, the only reason this one seems unprecedented is that it's happening in an economy in which the virus travels at the speed of an airplane, and the economic implications of it travel at the speed of electrons and financial markets. And then, of course, the other difference is it's happening to us. There aren't that many people left who remember the so-called Spanish flu of 1918 and 1919. There may be some who remember the Asian flu in 1957 and 1958, but even that is becoming increasingly old history. Anytime an economist tells you that things have never happened or these things always happen, you should keep in mind that never and always in economic data is really only 60, 70, 80 years tops. It's very interesting to look back at the Spanish flu in 1918, a little over 100 years ago. We don't have a lot of economic data from that era. There's no GDP statistics from that era. But if you go back and look at just headlines, the behavioral response, it is eerie almost how precise these headlines seem. The reaction to the Spanish flu 100 years ago in an environment without antidotes, without cures, without vaccines to hope for, led to things like quarantines, churches were closed, schools were closed, families were quarantined, the same kind of behavioral response. And if you fast forward to the so-called Asian flu in 1957 and 1958, here now there was a vaccination available, and the hope and the anticipation for that dominated headlines. And by the way, the second quarter of last year was, without surprise, the worst quarter of economic growth on record, going back to the first quarter of 1958, the only previous instance in which an economy, if you will, voluntarily shut down in order to slow the spread of the virus. There's good news, and you're aware of the good news. The average daily case count for new diagnoses of COVID-19 has fallen precipitously. In mid-January, nationwide, we were reporting something like 250,000 new cases a day. That was pretty awful. Since then, it's fallen down to about 60 or 70,000 cases a day. That's still pretty awful in an absolute sense, but the trajectory is in a beneficial direction. And perhaps even more encouraging, when you look at it on a state by state level, it's a pretty widespread phenomenon. The vertical axis on this graph is the daily case count on average in February versus January. So we see a deceleration in every state. And if you read the horizontal axis, it reflects just the prevalence of total cumulative diagnoses state by state. A couple of things to keep an eye on going forward. We're watching very closely the developments both in Florida and California. Those are two states where there is a higher than average prevalence of newer mutations of the virus. Thank God, so far, the vaccines have all seemed to be equally effective on these new variations, but that's something that warrants attention. And then the other thing that we're watching going forward is states that are relaxing their restrictions. Texas famously just yesterday, Mississippi as well, essentially have said, we are open for business, everything is fine, come on back in. Time will tell if that turns out to be premature. So if I may mix my metaphors, although there is light at the end of the tunnel, I'm not entirely sure that we're out of the woods quite yet. I'm very interested in life after COVID. Once we get through this, and once we move into a more normal economic environment, what are the lessons that we've learned during COVID that we will take back to business as usual? And we could do a whole 3-hour session on that alone. I'll do it in 90 seconds or so. At home, I think we'll see more consumption at home. We've simply gotten accustomed to it. An acceleration in deurbanization as people get more comfortable working remotely and come into dense urban areas a little less often. And then I think importantly for the economy, probably more savings and less debt. And we've certainly seen that happen over time. The trend has been upwards. It's been quite dramatic over the past year because of all the government programs to which Bill referred in his opening comment. And if anything, this explosion in savings, and you see where the savings rate is now, the difference between disposable income and spending is at 20%. That's an enormous rate of savings. That's the fuel that's going to cause the economic acceleration, again, that Bill referred to and resonates with me as well. Once we get through the worst part of the pandemic, there is plenty of fuel for the economic fire, so to speak. And perhaps more interestingly, from the standpoint of an investor, what are the changes in the workplace? Rejiggering of supply chains, less reliance on foreign suppliers. We will use Zoom a lot more often than we used to, better integration of technology, less travel is probably the other side of that. And then more remote work. And this is something I'm watching very carefully, not only from the standpoint of running a business, but from the standpoint of the implications that could have for various asset classes. Will companies be more profitable as workers work remotely? Will the real estate market take a hit as companies no longer need massive footprints, particularly within dense urban areas? It does not fall equally across the economy. Obviously, nothing does. Some sectors are more able to accept remote work than others. Finance and insurance tops the list, perhaps not surprisingly. This is data from the McKinsey Global Institute. Not everything will able to go remotely, but to the degree that there's even some shift towards remote work, that could accrue to the benefit of the bottom line and provide yet even a further tailwind to operating margins, corporate earnings growth, and therefore the equity market. So a couple of implications. I'm reminded of an old adage about disruption. I think it was originally applied to technological disruption, that in the short run, the implications are almost always overstated. So when people tell you breathlessly, we'll never go to the theater again, we'll never dine out again, that's overstated. We're a herd species. We delight in the company of other people. But in the long run, the disruption and the implications thereof are almost always understated. So as an investor, and particularly investing for institutions that think in a very long-term time frame, learning those lessons, understanding the business as usual implication of those lessons will improve your competitive advantage in the long run. And again, I say that from the standpoint not only as an investor and an allocator of capital, but as someone responsible for leading an organization as well. I think it's as true for the church as it is for the workplace. I will end there and stop sharing my screen and hand it back to Deirdre.
Thank you, Scott. It is helpful for us to hear from you as well about winners and losers in this recovery scenario that we're hearing. So we will talk now with Sonia Kowal of Zevin Asset Management. Sonia is president of Zevin Asset Management, and she runs both the strategic planning business practices and marketing with the firm, among other things. She is a member of the firm's board of managers and the investment committee. Sonia is a frequent contributor to various conferences in the realm of Jedi investing movement. She is our first Jedi to present on that topic today. What is Jedi? Jedi is justice, equity, diversity, and inclusion investing. It is a movement that has been sparked. It is made up of many actors. We are going to hear how investors are getting serious about this, and she will be sharing how Jedi investors are holding companies accountable for such things as inclusion in their workplace, hiring, promoting, supply chain practices, and how that can have a beneficial impact in communities and their environments. Sonia is very passionate about racial equity investing, gender equity investing, and addressing wealth inequality. And if you want to have a spirited conversation with her about what she describes as our disastrous criminal justice system, I would invite you to do so. She has much to say and share, and data at her fingertips on the matter. So Sonia, take it away, please.
Thank you, Deirdre. So Zevin Asset Management's been managing endowment accounts for 24 years, and we've always been an ESG firm a long time before it was fashionable. We're a majority women owned and led, and also a Best for the World B Corp, meaning that we walk the talk of sustainability. And our clients invest with us because they want to improve their portfolio risk return characteristics. They want to align their investments with their mission, and they also want to achieve a positive environmental and social impact alongside their financial returns. We do a lot of hand-holding with our clients and help them to become better investors through education and sharing experiences. So Episcopalians have been successfully integrating faith considerations into their investment portfolios for decades. But today I wanted to discuss some more proactive and practical approaches that faith communities have been using to influence and benefit from social and environmental trends, some of which we've already discussed today. So how can we create a portfolio that addresses the risks and opportunities that come from investing inclusively, especially through the carbon transition that our economy is going through? So I hope each of your investment committees and advisors and managers is focused on this question, because it's really important, both from a financial and social perspective. Our new administration is rightly very focused on climate change and decarbonization of the economy. And that's opening up a lot of fruitful opportunities for companies and for investors that know how to look. So for example, many areas such as renewable energy and storage, electrification, green transportation, water access, those things are booming. There also are a lot of risks that are coming from disruption due to regulation and the technological shift to a low carbon economy, as well as the risks associated with the impacts of climate change itself. So facilities are getting more damage from these increasingly severe storms, Texas, for example. One of our larger peers in the UK called Schroders calculated that 15% of corporate earnings are at risk from an increased carbon price. That's a lot of money to leave on the table. So a lot of money to be made with this theme, but also a lot of money to lose for investors who aren't keeping up. And something that I think is also important to keep in mind is that unless the transition to a low carbon economy is done equitably, this whole process will fail, or it will further exacerbate tensions around inequity. The phrase you may have heard around this work is called the just transition. You may also have heard of the phrase stranded assets, and that's used commonly to describe fossil fuel companies who may not be able to profitably extract their oil and gas in the new economy, and that will cause large falls in the valuation of their companies on the stock market. So now they're also concerned of stranded workers and stranded communities who will be left behind as our climate changes, and also by the initiatives we put in place to combat climate change. And in this new paradigm, investors are going to need to be extra cognizant of commitments to labor standards, human rights, and inclusive growth, and then focus on workers in the communities who contribute to and are affected by the transition. And this work has come a long way over the last few years. And so rather than just having portfolios that are fossil fuel free, and that's really just the bare minimum these days, ask your managers how they're assessing the climate preparedness of your portfolio and the degree to which your assets align with a 1.5 degree global warming scenario. The future's coming, the future's now. Something else that's really important to think about: social justice movements are early indicators of risk in public markets. And given the Episcopalian Church's focus on social justice, I think you are uniquely placed to think about this and act on it. And a key issue within social justice is race. And race is just one of the lenses that we use at Zevin Asset Management when we pick stocks for our strategies. You know, we obviously think about environment and human rights more broadly, et cetera, but it's about reducing risk and seeing the whole picture of what's really happening in markets and the world around us. And that view is becoming increasingly widespread among market participants. So you see S&P, the ratings agency, they published recently that they consider workforce diversity as well as safety and management and community engagement when evaluating a company's exposure to social risks and the effects of those risks on credit quality. Research has shown that firms in the top quartile for gender and racial and ethnic diversity are more likely to have above average financial returns. And McKinsey anticipates that by closing the racial wealth gap, GDP could be 4 to 6% higher by 2028. That's a huge boost, never mind all the other wonderful things that this shift would bring about. So on the slides, you see some examples of how investors can think about investing with a racial justice lens. So these are divesting from organizations that profit from mass incarceration, divesting from those that have a disproportionately negative impact on communities of color, understanding institutional racism in company practices, asking companies to really think about criminal background checks, urging companies to pay living wages, reinvesting in community development, financial institution, affordable housing, et cetera. And I think that's what James is going to go into. Investing with diverse managers, that's a really important one. And just generally using an investor voice to advance anti-racist public policy through investor statements, public comments, and that sort of thing. And the Interfaith Center for Corporate Responsibility is a really good place to engage with through that. And on my last slide here, I've corralled some pertinent questions that I think endowments should be asking of their advisors and managers around ESG and impact. And you may not receive good answers, but that should be a really strong signal to you that you are not really getting the benefits that the answers to these questions will help with. So, you know, that should be a strong signal to you. So with that, I've got 2 pages of resources around climate change and around Jedi investing. So I think these slides will be sent around to you so you can peruse them at your leisure.
Thank you, Sonia. And thank you so much for reminding us that investing responsibly is a form of risk management for our endowment portfolios. This is something that we have had to learn, some of us the hard way, and I think that it's just worth repeating. So we appreciate you speaking really as our first Jedi, and also for covering inclusive workplace. We're going to hear more about how investors are getting serious about closing the severe generations-long wealth gap, because we know the magic of compounding works in a negative way as well as a positive way. And I just want to say, the system isn't broken. The system is fixed to work the way that it has worked. So we're here to hack it. We're here to transform it with our capital. And I want to remind us to think about how a lack of justice and opportunity compounds its impact through generations, widening the gap more and more. One of the ways to reverse that momentum is to actively support Black, Indigenous, and people of color ownership of home, ownership of property, ownership of business. That's the gateway. That's the gateway to building real assets, family wealth, and a stable, prosperous community. So we're going to hear now from our friend, James Malone of Community Capital Management. He is our Jedi number 2, and he is a restorative investing expert in the fixed income arena. He is the Chief Financial Officer and Chief Diversity Officer for Community Capital Management, which won a Fixed Income Asset Manager of the Year award in 2020. James oversees the firm's finance operations and financial reporting, as well as establishing policies and seeking opportunities to foster an inclusive, equitable, and supportive work environment. He serves on CCM's board of directors. He's a member of the management committee, the Diversity, Equity, and Inclusion Committee, which I think should be renamed to the JEDI Committee. He's also someone who assists with valuation and compliance. And he's just one of our favorites. James is going to be speaking to investing in vulnerable communities and specifically addressing the Black homeownership gap. James, I'm turning it over to you, and we'll ask you to also please share your personal story with us today.
Okay, thank you. You've given me license to go over now. Well, thank you so much, Deirdre. That was a great introduction. I'll take you around with me anywhere I go to introduce me. Also, Sonia, as you were talking about, JEDI and how folks can invest in a way to address racial inequities, I was trying to get out of my seat, but I decided to sit. So very excited and passionate about this topic that I'm going to talk about. Generally, impact investing, how you invest with purpose to impact communities, especially underserved communities, something I'm passionate about, and you'll see why a little bit later on. And I like to say that I'm the luckiest man, like Lou Garrett said, because I'm blessed to have an alignment in my career, my personal faith, and my community work. And one thing that Deirdre didn't mention is I'm mostly looking at numbers as a CFO, but one of the things that I said, please, you have to allow me to do at the firm, is that I interact a lot with faith-based organizations and individuals to talk about what we do and to do business development there. So I just love this opportunity to be a part of this group. So by quick background on the firm, I wanted to point out Community Capital Management is an impact investment manager, and we have been in business for over 21 years. We have experience in managing impact and ESG investments. We manage about 3.3 billion in assets and have around 33 employees across the country, mostly concentrated in Fort Lauderdale area, but we have an office in Boston and folks in Charlotte and the West Coast as well. Now, our flagship strategy is our core fixed income impact investing strategy. To date, we have invested on behalf of our clients approximately $10.5 billion in communities all across the United States. Our clients are quite diverse, from high net worth individual, faith-based investors, as I mentioned before, and banks and not-for-profit organizations and institutions. Our core fixed income strategy has a primary focus, and that is to invest in publicly traded bonds with multiple positive impact outcomes across 18 impact themes. And these impact themes range from affordable housing, neighborhood revitalization, environmental sustainability, gender lens, minority advancements, and the list goes on and on. In the short time, I'm going to jump right into what has been sort of a focus for us, for me, in the last year. Now, it's been 20 years of investing this way, but the year 2020, you talk about 2020 vision, 2020 gave us some clarity around what we need to do to address one particular societal problem or solve for that. And it has to do with home ownership. And there are lots of economic data out there that we looked at after what happened last year with the heightened awareness of systemic racism and discrimination affecting minority communities. And the two I want to look at in terms of data, in the top left, you have the median family wealth by race and ethnicity. And it shows that in the 1960s, there was a $48,000 gap in wealth between non-whites and whites. In 2019, the data, the compound, Deirdre talked about compounding, how problems compound in the other area. The gap widened significantly to $144,000 between whites and blacks. And that's huge in terms of the wealth gap. And that has consequences, and we see the evidences of that in our community. The other data point is at the bottom right, has to do with the home ownership rate by race and ethnicity. And you can see in the 1960s, there was a gap of about 27 points between blacks and white in terms of home ownership. It's a little bit less with other minority groups. And then by 2019, it was 30 points. So it's close, it stayed around the same, but it even expanded a little bit by 2019 when it should be going the other way in terms of home ownership by race. We believe that this is primarily responsible for the wealth gap that we see above. So for decades, communities of colors have had systematic disinvestment. Since the 1930s and 40s, government programs systematically excluded minorities from housing and even education. The economic disincentive included what is called redlining. And I think a number of you might know what that is, but it's basically the practice of putting financial and other services out of the reach of residents just based on their race and ethnicity. And redlining has historically been a major contributor to the poverty and the racial wealth gap. And that's reflected in the socioeconomic and environmental and health conditions that communities of color still face. So think about it. Home ownership, the American dream, is one of the primary tools for building wealth in America. But home ownership has failed to benefit Black Americans as much as it has benefited white Americans because of the long history of unequal treatment. Now, mending the Black home ownership gap, which ultimately we strongly believe will reduce the wealth gap, is not something that's going to happen overnight. It's going to take years to make profound impact with this serious issue. And the pandemic and everything that happened last year, I think, has exacerbated that problem. On this slide, there's a 5-point framework that was established by the Urban Institute that we really like, that look at how parties can come together and the way we can address this wealth gap. And it talks about from advanced policy solutions at the local level, and local is a key word here. And that's like reforming local land use and zoning laws, strengthening access to home ownership, and in the CDFI network. There's a lot that's there, and we could have a whole session just dealing with this 5-point framework. It talks about tackling home housing supply constraints and affordability, promoting an equitable and accessible housing finance system, and accelerating outreach and counseling for renters and mortgage-ready millennials. And I'm a part of the Urban League of Broward here in Florida, and one of the most populous programs we have in services has to do about getting people ready to buy a home. And the classrooms always filled every time we have those sessions. So I'm not going to talk about each of these, but what I would say here, the takeaway is that there's a need for collaborative partnership among public institutions, private capital, and philanthropic support to successfully address the home ownership gap. You have to have that three-pronged approach. And so the question is, as people of stewards, what are we to do? As people of faith that have a responsibility and stewardship over endowments and the treasurer of our faith-based organization, what are we to do? And the key thing here is that we are inspired to use our time, our talents, and our treasure to make a difference. So I would say for a time such as this, I believe we have an opportunity to lead the way, to invest with intentionality and purpose to reduce Black homeownership gap and ultimately the wealth gap. And I'm going to give an example here. But before I give that example, I just want to say, just imagine that you have a dartboard, and Sonia talked about all of the different things that can be done around investing with a lens, for gender lens or race and equity and all of that. But all of that's on the dartboard. But for me here, the bull's eye is home ownership. And what if you could invest where you're just zooming in on that bullseye to encourage more Black and minority home ownership that ultimately leads to reducing the wealth gap? For example, as part of our fixed income strategy at Community Capital, investors are able to invest in affordable mortgage pools that were custom created and made up of loans to low to moderate income Black and minority borrowers. And we have that ability from working with originators to say, here are the loans we want in that pool that's targeting the Black and the minority borrowers. The goal here is to increase capital for the historically disenfranchised family, work with traditional lenders and minority banks and local lenders, CDFIs, not-for-profits organizations, to create lending programs that include things like financial literacy and counseling, et cetera, that encourages not only just getting a home, but having the ability to keep that home. So what we're looking at is investing with purpose, where you're driving capital to those borrowers to finance those borrowers, but also when you have that scale, you're able to now encourage the lenders and the originators to provide programs and counseling and work with other not-for-profit organizations and the whole ecosystem of housing to make it so that these borrowers are economically resilient and they have sustainable home ownership. And we are very excited at Community because last year we launched what's called the Minority Community Advancement Racial Empowerment Strategy Initiative, called Minority Cares, where we are actually focusing dollars to those borrowers. And the more we're able to do that, the more we're able to create demand and drive capital there and have access to capital. I've said a lot, and I'm sure there will be time for questions and answer, but I wanted to say finally that this is something that's very personal for me, because over 50 years ago, my aunt bypassed racial discrimination to obtain a FHA loan and purchased her first home for $25,000 in a beautiful neighborhood in Boston. And I love that neighborhood, that suburb in Boston. That same two-family home that she bought back then is valued today nearly $1 million. Think about the wealth creation there. And because of that home purchase, she was able to build middle-class wealth over the years and use it to send her kids to school, to do a lot of different things, refinance, help others in her church, just a lot she was able to do by having that home. But one of the things that's really personal for me is because of that purchase, 23 years later, she was able to help her young nephew, me, who migrated from the Caribbean with only $1,000 in my pocket and a dream to get a quality education in an excellent university in Boston. And I was able to go to school and to get her help just because she was able to build middle-class wealth from the purchase of that home, which she was being blocked and found a way around back in the day when there was a lot more discrimination happening. So I'm gonna sort of close in saying that dismantling structural racism, and if anyone you've heard me speak before, this is something I really care about. Dismantling structural racism that leads to economic inequities and investing with purpose in these communities is not just an exercise in theory for me. I know that it changes lives, it creates opportunities, and it allows people, someone like me, to have the opportunity they otherwise would not have had. On the screen is an example of a mortgage pool that's targeted to minority individuals, mostly Black here. And this is something we just put together in the last couple of months. But the takeaway I want you to have is that having more of your endowment dollars zooming in this area could do a whole lot in terms of reducing the wealth gap. And I personally think more than anything else that's out there.
James, thank you so much. Thank you. Your timing is perfect, my friend. Thank you so much. And thank you for helping to make the case, make the business case as well as Sonia did in mentioning the McKinsey report. The data is helpful. We're not just talking about social science. We have hard data now. For our attendees today, I'm sure that you find these insights and viewpoints and that some of the data that's being presented constructive. We are going to have much more for you. We'll put up a link in the app, in the session. We'll put up a link to various resources, which will include, we'll get the link to the McKinsey report that Sonia mentioned. I'm going to include the Kellogg Foundation's report from 2013. It was making the business case for racial equity. It was initially created in 2013. It was updated again in 2018, and the 2018 report is excellent because it has much more data, it has numbers, and it really helps investors, I think, seize the opportunity. And I think it will be helpful for investment committees to be able to review and see some of these materials. Turning now to one of our other data divas, Jedi investor number 3, we're going to be talking to Becky Brooks with Morgan Stanley. And I have to say, Becky has been a long-time supporter and contributor to SEEP. She's been a really important voice in the endowment and finance sessions. It's nice that at SEEP we see so many women who are active and engaged and empowered within this area of intelligence. And she's with Morgan Stanley, so she's with a firm with longstanding and rich resources. She's going to be sharing some data with us today. I'll just tell you that Becky's a financial advisor, as I am, and she's a director of impact investing with Morgan Stanley. She works with individuals, but also with endowments and institutions. She works to provide investment consulting services and to align risk return objectives and broader operation missions of endowment and other institutions. So she joins us as a longtime contributor to SEEP. She's one of our impact investing experts. A lesser known fact about Becky is that she is an athlete and an accomplished coach. So if, like me, coming out of COVID, you might need someone to help set your goals for your health, she's a really inspiring person to talk to and to read about. Becky's going to be sharing new research on racial equity investing and things to consider as well for 2021 for a recovering economy. As you've heard from Scott Clemons and from Bill Jarvis, in particular, we had some capital markets and sector outlooks. And so she's going to be filling that in a little bit more for things to consider for a recovering economy. Take it away, Becky. Please unmute yourself.
Thank you, Deirdre. And I love the comments about being an athlete. I don't really feel like an athlete lately, but I'll take it. And I'm thankful for that. So it's a delight to be here today. Deirdre, thank you very much for organizing this great panel. Thank you to all the SEAT members that are tuning in and that have been very actively involved in all these conversations about endowment management, investment management, and investment committee management. It's all been so rich. For those of you who did not watch the session that was this morning, a lot of really wonderful things were said there as well. So just kudos for SEAP and Deirdre for getting us on the right path for really rich discussions. It's difficult to follow up James Malone, but I just want to say Community Capital Management is a terrific partner of Morgan Stanley's, and certainly a manager that we work with very, almost in every portfolio for a client, whether it's an individual or it's a nonprofit foundation, endowment, for anyone that wants to create an impact. So James, it's terrific to hear from you. If I went, and then just lastly, just a shout out to you, Deirdre, about the participating on a panel so wonderfully designed for a time such as this. And so I really appreciate it. Here we go for 2021. I will be highlighting two important themes for 2021 that Morgan Stanley has put a lot of time and effort into. The first one is investing for racial equity, and we have a lot of material on our website, on our virtual booth here at SEAP that you can access. Here is the paper that was recently published in Morgan Stanley. I'll go into that. And then the second theme I'll be talking about is positioning a portfolio for a recovering environment. So of the two, I'm trying to keep it into bite-sized pieces for you all, not to overwhelm. The census has been a lot talked about already today, but the two themes I'll be mentioning today of racial equity and recovering economy. I hope you enjoy the alliteration with that. And with that being said, I am rip-roaring ready to go and share my slides. So let's see if I can get those up. Great. So racial equity investing. This is a topic that Sonia's touched on, and obviously James has touched on. And at Morgan Stanley, we have been focused on the entire spectrum of what we call investing with impact since 2012. So in 2012, we founded that group within Morgan Stanley Wealth Management. And since that time have invested a tremendous amount in expanding the platform, creating thought leadership pieces that can really help our clients that are interested in either aligning their investments with their portfolio, with their values, aligning their investments with their values, or also creating an impact on many different levels. And so if you were to think about in 2009, when the term gender lens was coined, a tremendous amount has happened since then. We have had not only significant research on how diverse companies outperform companies that are not diverse. We have lots of investment strategies that are out there that we can tap into and use to employ that, a gendered equity type of investing. And then lastly is that the information that corporations voluntarily give out to report on has changed dramatically since 2009. And this is all three categories is real hope for me when I think about investing in racial equity. It's almost a template of where this movement can go. Certainly it came before 2020, but 2020 highlighted it. And I think it's going to be a tremendous 10 years in this category. So in the past, since gender lens or gender equity investing has become popular, out of the Russell 1000 companies, about 400 of them report on either equal pay raise or gender diversity within management, all sorts of different voluntarily. They're not required by regulatory agencies reporting. If we think about racial equity, it's 40 companies. So we want to bring that 40 up to 400. And with reporting can come transparency and can come change. So that is, yeah, I feel just so much hope when I think about this term racial equity investing. And again, just a plug, a lot of the information you can see on the paper that we put on our virtual booth, not only of the data about how more diverse companies do better, but then also different ways that you can invest. And then at the bottom of the slide, you can see kind of 4 general ways in order that an investment committee could do this. One is restriction screening, right? You take out all the bottom performing or those companies that either not reporting on racial equity or have had litigation issues in the past. You throw those companies out. Seems like kind of a no-brainer if you want to upgrade your portfolio. The second one is leaders. So, let's look at the other spectrum. Let's look at the companies that are reporting on racial equity. Let's think about the companies that are coming out there with statements and making initiatives in this area. Let's tend towards them. And the data again shows that companies that do this are more profitable and run better than companies that don't. The third is on solutions, and James touched upon that in the fixed income market, and that is let's look at companies that are actually trying to address the problem and create solutions. So there's a couple examples here on the screen from affordable housing, criminal justice reform, Sonia touched on that, economic inclusion, and so forth. So that would be a whole nother area of a portfolio that you could pay attention to. And the last part is ownership. And great strides that we've been making as a firm, and I'm sure the other firms on the panel have been doing as well, is let's take a look at how many minority asset managers we have on our platform. How many of them are with diverse managers, how many of them are with women managers, and how can we increase that? The numbers are pathetic when you think about managers that investment committees have access to that are in diverse categories. So with that, again, there's a lot. I'm happy to reach out and speak to anyone about this very exciting new topic that Morgan Stanley's done a lot of research on. The other topics within impact investing that we have done white papers on and provide a lot of information on. 2 of them having to do with faith, investing along Catholic values, as well as investing along Jewish values. They're very interesting reads if anyone is interested in how you take an Episcopalian point of view or a Christian point of view and where to express that through your investing. And then obviously lots of research on the climate side, as well as a gender diversity side. And I'll go to the next slide. So I'm going to transition now into a recovering economy. And this has been touched on already by Scott and by Bill. But you can see here, it's kind of the topic of the day is how much more stimulus is going to go into the economy to help us recover from I promised myself I wouldn't say the word COVID, but from COVID in this presentation. And you can see that compared to 2008, the response from the government and from the Reserve has been just tremendous. What this has led to is, unlike 2008, which is the yellow line, now here in 2020 going into 2021, not only have we filled the hole, which was the main goal in 2008, but we've gone past the hole. And so we're really spurring economic activity and not just getting back to a baseline. here, the line here is not an S&P 500. It's called the value line. It takes into account a lot more companies than an S&P 500 type of index. But here you can see that, with the bull market, and then we were in a bear market since 2018. And bear markets end in recessions. And the COVID crisis, was the recession that ended that bear market. I think a lot of times you thought about that economy kind of, it always felt like we were reaching new highs, but when you look at it on this chart, we were not. And so, now we're at the beginning of a new bull market. That's going to lead to, we don't know if that's going to be another 12 years like it was the last time, or if it will be shorter, or if there'll be moments of stagnation for sure. But here we are at the beginning of a new bull market. And then you think about what that means in terms of, and you can see it on this chart, of the outperformance of cyclicals. And that is companies that are tied to the cyclical nature of our economy. And so they have significantly outperformed since October. So that's something to look at as you position your portfolio for a recovering economy. And in those cyclicals, we do, Scott mentioned them before, Bill mentioned them a little bit as well, financials, industrials, a little bit of consumer discretionary, and energy. The NIPA profits is actually a measure of corporate earnings. And so Scott mentioned a little bit earlier about how, the consumer is in very good shape as we are getting out of this recession, and indeed are primed to not only get back to where the economy was, but move forward pretty quickly. Corporate earnings have never been better. And we haven't even hit Q2 of 2021. So again, this shows that although it does not feel great, no one feels great staying at home, and no one feels great with all the tragedy that's in within our economy right now. Corporate earnings are at a high and are primed to just continue to go up as the economy recovers. And you think about a recovering economy, and you look at pockets of the market. I already mentioned cyclicals that you might want to think about. Another area was small caps. And yes, they've already had a great rebound, but you look at the rebound after 2000, or after the tech bubble in 2000. And that rebound went on for quite a way. So we've already had quite a significant and strong rebound in small caps, but we're thinking that will probably continue when you think about a recovering economy. And then lastly, another pocket of the market is value-oriented companies. And the blue line at the bottom is from 1995 to 2002. And you can see its growth over value, and how that growth, we all lived it. Growth really was reigned, king and supreme queen for quite a while. And could that take a turn? This chart suggests that that it might, and that a lot of different areas of the market will do well, and not just the high-flying tech stocks. So that is all I have for you all today. I'm happy to follow up with anyone who wants it. And Deidre, I turn it back to you.
Thank you so much, Becky. Thank you for the data. That's very good information to have, and thank you for for adding to the recovery outlook, providing us with Morgan Stanley's thinking and some additional things to consider regarding sector positions as those pockets that you mentioned. We're going to turn now to our friends with 1919 Investment Council, John Riley. John has been presenting at SEEP for many years in the endowment and finance sessions. John is a principal and portfolio manager with 1919 Investment Council. His primary responsibility is overseeing portfolio construction and monitoring them for institutional clients, such as Episcopal endowments. He is also serves on the Asset Allocation Committee. And if you've heard John speak before, we're going to be talking about asset allocation, and he's going to share some charts with us. John focuses us on maintaining the long-term view. Bill mentioned that up front. let us not be short-termist in our thinking. He focuses us on maintaining the long-term view and making sure that a strategy is in place to help navigate the challenges and events that we may experience in the markets, such as the risk that we all saw and may have experienced at varying levels in 2020, particularly back in March. A lesser known fact about John is that he is an Eagle Scout, and he says that an Eagle Scout never retires. Take it away for us, John.
Great, thank you for that introduction. I appreciate it. I'm going to share my screen now, and I want to make sure everyone can see it. Everyone see the screen, Deidre? Do you? Good? Okay, great. Well, thank you very much for the opportunity to speak today. And as Deidre mentioned, I'm going to touch briefly on what we need to consider for the long-term view and thoughts that we should take away from what we experienced in 2020, kind of thinking about where should we have been, what happened, and then what should we think about in terms of positioning and moving forward. Just a brief introduction on our firm. We've been around for over 100 years, thus the name 1919 Investment Council, a little over 17.5 billion in assets under management, with a little over 1.8 billion in working with responsible investing strategies for clients that engaged in that based on mission or faith values investing. And so we've quite a bit of focus on this space and the implications for endowment and foundation boards, thinking about the longer term impacts of this. So kind of to start out, I think it's always helpful for committees and foundations to think about, let's just take a step back based on everything that happened and say, do we have a couple of basic things in line right now? Do we have an investment policy statement? It's a very important thing, and I believe that was touched on earlier in the sessions. It's very important to have a base. So what is our investment policy statement? Is it in line? Is it updated? A lot of times investment policy statements were created from committees years ago, and a lot of the members necessarily aren't on those boards. So do we have one? Is it updated? Is it consistent with what the mission of the church is now? So making sure we have those considerations in place. What is the spending policy? This is a big deal, especially as we think about spending policy in the context of a down market. When the market's down 10% in one day, you really think about spend. How am I going to spend that? Do I have the liquidity available to do that? So thinking about what is the spend and what are the options we have to adjust that spend, kind of thinking about if we had to ratchet it back, if we could increase it, what are the different components of that spend as we think about that. So just some real baseline things to be mindful of as we kind of look forward. And then the next thing is looking at how did we do in 2020? This is important to understand what worked and what didn't work. We went in this with certain assumptions of how the portfolio would behave based on certain market assumptions, certain probabilities. Were our initial thoughts in line with what we actually experienced? So kind of taking a look back and saying, it did work, it didn't work, it was more risk or less risk than we thought. What was our downside? This is always a big component. I know a lot of committees focus on what's the return and how did you do? But equally, and in some respects, more important is the risk consideration. How did we do on the downside? Did we lose more money? Because, and I'll highlight this in a little bit, this was a unique circumstance because the drawdowns were severe, they were quick, but the recovery was equally as quick. And there's other time periods in history where that wasn't necessarily the case. So understanding what is the downside, because there have been worse events in terms of longer duration negative market downside events that have occurred in the past. And then also thinking about what actions did we take during the crisis, during the summer, during the fall, what kind of decisions did we make that were helpful or hurtful? Did we have issues with liquidity? Did we have issues with individual holdings? Did we decide to get out of the market, get back in the market? Were we trying to time it going in and out? Because that's a very challenging exercise, because you have to be right twice. You have to be right getting out, and then you have to be right getting back in. So what did we do as a committee? And how did those outcomes kind of provide value or detract value? And I have just some random kind of numbers to kind of share about those thoughts. And I don't know if you can, hopefully it came across okay, but this is a chart looking at the 25 best and worst days of the S&P, but within the graph itself, the 10 best days and the 10 worst performing days. And I added these red arrows to highlight the time period we went through last year. And you can see the 10 best days since 1987, 3 of them were last year, 2020, 2 in March, 1 in April. And then if you look at the 10 worst performing days, March 16th, March 12th, and then March 9th. So it's good to be mindful of, did we panic in a sense and sell out of the market? Because it's really tough to really be good at moving in and out of markets based on fear without understanding really the longer term consequences. And there are longer term consequences to making more sporadic decisions based on some of this. Because if you had gotten out March 16th, you would have missed the bounce March 24th. And conversely, if you had gotten out the 12th, you would have missed the bounce on the 13th. So it's important to be mindful about actions that are taken in these types of situations. And that's why having an investment policy statement is such an important component of any foundation or endowment, because it does set the stage to understand the longer term approach, given the understanding of volatility that does evolve and does occur within the markets themselves. Another chart here showing, if you had been out the best month in every year. So let's say you missed March or you missed April, what would that have done? And if you had a policy or a practice of doing that, over the longer term, it's detrimental to the value, the returns that you would expect. Another little data kind of point, if you missed the best days since 1928, the 5 best days, the 10 best days, again, those impacts cumulatively add up over time. And given that a lot of these assets, a lot of foundations and endowments in essence are in perpetuity, the compounding effects of basis points here and there do compound over the longer term to have more of a negative impact. So kind of looking into 2021 and really beyond, what are we thinking about? What should we be thinking about in terms of how the endowment foundation assets are aligned? So first off is the asset allocation in line with our IPS. This is a very important consideration because in a lot of times, given the strong equity markets we have, there might be pockets within the portfolio that might be underweighted or overweighted, especially within the equity portion. So being mindful of our asset allocation ranges, mindful of targets, where are we from that standpoint? Because in essence, by being more overweight than you think, you are indeed increasing the equity risk and the portfolio risk. So being mindful about that. Is our asset allocation in line? Is our spending policy in line with our asset allocation? Is it commensurate with what we expect the draw to be, going forward? And the other thing to kind of consider in terms of that is, where are we getting that draw from? Where does the liquidity come from as a committee? If we experience a similar March, April time period that we did last year, even fixed income markets seized up to a certain extent. There were liquidity challenges in accessing some fixed income markets. You could get stuff done, but there were wider gaps and there were anomalies. And so you want to be mindful of, do we have liquidity? How much liquidity do we have? Is it truly liquid? Does it make sense, especially in this type of environment with lower rates, to keep more cash relative to fixed income? So thinking about that component, because all these things kind of come together. Because again, as I mentioned, this was a very severe market correction, but the recovery was very rapid. And I'll show you here how this actually can, over the longer term, can be more impactful. So this is an example of different asset mixes, more conservative from the left to more aggressive on the right, and different asset allocation strategies from 1988. And you can see these are calendar year returns. So we actually had positive returns, even given the severity of the market last year, but we could have negative years for calendar year returns for strategies. And it does happen. So being mindful of short-term liquidity risk, short-term drawdowns within asset values, within portfolios, foundation assets, but also thinking to ourselves that what we experienced was severe, painful, and tragic, but it has been worse for equity markets in historical times. So in a way, kind of thinking to ourselves, what we just went through, how did it feel? Were we comfortable with the outcome? Are we positioned for where we think we might be, given that there is the historical precedent of having years where could conceivably be worse than what we had. So that's something to keep in mind. And then the intersection again of, I refer to this quite often a bit because sometimes the goals are not aligned with the asset allocation. The spend, is our spend commensurate with our asset allocation? And a lot of times there's a hesitancy to have a more aggressive equity allocation to assets because they're kind of concerned about losing money in the near term, and that is a very solid and insane rationalization for having more conservative allocations. However, over the longer term, you need the ability to draw on assets, and really the way to get the growth in the assets over the longer term is having equity exposure, given that fixed income historically has not provided that type of growth necessary for draws. And so what I did is I provided a chart that kind of looks at a draw of 3%, looking at a draw of 5%, and the differences, because in the shorter term, certainly there is more variability in the probability of success of having the initial value or percentage of the initial value. But over longer periods of time, even among more conservative asset mixes, but more so those with higher equity allocations, there's a higher probability of success of being able to meet those needs, both at 3 and a 5% fixed rate, depending, kind of based on history. So I think that's important to think about as we kind of think about what happens and where are we going as a committee. And certainly things to be considered when developing investment policy statements, when thinking about how we're positioned now and what the future might be.
Thank you, John. We appreciate your contribution. I'm sure investment committees are going to be having interesting conversations about the 4% rule, which was talked about as the 3.5 or 3.75% rule last year. And now it's being looked at as the 4.25 to 4.75, and some are even saying 5% rule. So let's be careful and thoughtful with that. Before Bill Jarvis wraps us up, we're actually going to give Sonia a couple of minutes to speak about some exciting things that are happening in the advocacy and engagement field within Jedi investing. I'm not sure which company she's telling us about today, if we're going to hear about Apple, or we're going to hear about UPS, or we're going to hear thorniness from Amazon. But I'm going to turn it over to Sonia. Sonia, you have 3 to 4 minutes, and then it's Bill.
Yikes. Okay, let's go. So most of you probably have Apple in your portfolios. It's such a ubiquitous stock, and we all have a lot of cognitive dissonance about Apple, right? We choose to ignore the issues at Apple that are well known, large human rights and ethical problems inside Apple's vast global supply chains, or consumers of their products. But at the same time, that failure to find a permanent solution to these recurrent labor issues and environmental issues in their supply chains is just not acceptable, right? And one thing that as investors we worry about is that the seeds of long-term risks and business interruption are being sown. And a company such as Apple really should be able to fix them. So a couple years running, we've led shareholder proposals at Apple asking them to put their money where their mouth is by linking a portion of executive compensation to sustainability metrics. This is already being done at other large tech companies like Microsoft and Intel, so it's not this weird idea. And what we found is it's really the only thing that works. If you are getting paid less because you're not thinking about ESG, you're going to think about ESG. So we had the backing of 3 large shareholders. We worked with the state of Rhode Island's pension fund, the investment arm of the SEI union, and the Quakers. And we went to Cupertino this time last year, and we presented a proposal to the board about linking Tim Cook's and other executive pay to ESG. And we really focused on diversity, equity, and inclusion because we think Apple really has a huge problem there. We've only got 12% of the vote, right, from other shareholders in favor of our resolution. It's not actually too terrible a vote for a new resolution, but it was enough to get management attention. And after that meeting, they reached out to us to discuss it further. And then after a few conversations, They told us they were going to do this. So starting this year, for the first time, bonuses for Apple senior executives are going to include an ESG modifier. So up to 10% of their cash bonus will be subject to Apple meeting ESG goals. So it's just one step, but we think it's really significant and really important, because without that, things don't change. You know, we all have airy-fairy goals, but unless your bonus is linked to them, chances are you're not going to do anything about it. So I'm kind of proud of that one. Another quick one.
Thank you, Sonia.
Yeah.
Okay, we appreciate it. We want to hear more. I think that your booth can be visited on through the app. Okay, thank you so much. Bill Jarvis, you are our closeout Sherpa.
Sherpa, we've gone to the mountaintop and come back down again. I hope that you bring away from this, those of you who are on this session, two main themes. One is this tremendous sense of unity that you heard from all of us. It's not that we've all drunk some magic beverage and believe that the economy is all going to go in exactly the same direction, but you can see the way things are emerging fitfully at stops and starts, but into an era which certainly we, and I think our colleagues, Brown Brothers, Morgan Stanley, and 1919 and Sonia, agree that we're going to come out of this in a transformed way, not really comparable completely with what we had before. And some of this is going to be suppressed demand. Some of it is going to be adoption of new technology, acceleration of these things. Some of it is going to be demographics. But these are topics that you should inform yourselves about if you're on this call, because these are the things that will drive the investment decisions that will be made by the managers you hire for your portfolios. The second major theme that I'd like you to come away with really drills down to James's work and Sonia's work. We now are coming into a world where talking frankly and openly about these wrongs that were done in the past, and it still persists to this day, has become not something that people do in a little room quietly by themselves, but is now done frankly in boardrooms, in investment committee rooms, in areas where decisions are being made about investing. So from that perspective, I think it behooves you to think about what James is doing, what Sonia is doing, and how these themes can also be incorporated, not even as a separate thing, but into the mainstream way that you're thinking about your portfolios, because this is the way society is going to advance and open. So with that, I will hand it back to Deirdre with thanks to all of you for a tremendous discussion and participation.
Thank you, Bill. We really appreciate your being our opener and closer here. So thanks again, indeed, for your time. And thank you, Sonia and Becky. And thank you, John and Scott and James. We want you all to get ready for the keynotes. Darren Walker with the Ford Foundation. The Ford Foundation is cutting edge on going fossil fuel free with their investing. They're excellent mission impact investors. It's a real score that we have Darren Walker speaking at our general session today. It starts at 3:30, so I just want you all to prepare for that and to be there for that. And again, I commit to you all that we will be posting a compilation of resources to add to your intelligence that we know you've already begun. If you feel uninitiated in the areas of responsible investing, mission-based investing, place-based investing, racial equity, gender lens investing, environmental investing, et cetera, I think you can reach out to any one of us who have been present here and who are certainly engaged in that arena. And so I see that there was a question posted about how I would send the list. I actually have the email list of attendees in addition to being able to post it on the app. I will do both of those things. And we thank you so much for your time. We thank you for your talent, and we wish you great success with your treasure. Thank you very much for attending today.